Greetings, class. This is Finance 101, and this is the Wednesday, April 15th video covering the material from Chapter 10 and a few announcements. So I want to start with an announcement I think is fairly important and could be applicable to you. I've had some requests to go back and reopen some homework assignments in the past. So what I've decided to do is to open all of the homework assignments between now and next week um, for you. If you have anything that's not been submitted, you can submit it in that time. Now it'll be late, but it's better than not submitting it at all. If there are some assignments you've overlooked or some things that are missing in the grade book, go back and check them and make sure that you have those submitted. Otherwise, they'll count as zero, and that will adversely impact your grade. So if you have anything like that, make sure you go back and take a look at that this week. I will have that open beginning tomorrow. You'll be able to start doing that. Okay, so for today, we want to talk about Chapter 10. And I want to mention here also, due next week will be the Chapter 10 homework, the retirement homework, and then an attendance quiz over Chapter 10 as well. So these two items are due by next Tuesday at 11:59 p.m. Just make sure you get those submitted. Okay, so now I want to go to the PowerPoint that we have for today, and we're really looking at basically an overview of planning for retirement. Now, for the purposes of this class, we're really talking about a broad stroke approach to this. We're not going to get into anything extremely in detail, but we do want to cover this. And so in Chapter 10, we're going to cover three topics. We're going to discuss number one, the need and responsibility for retirement planning. Number two, how to use IRA accounts to save for the future. We're going to skip number three. We will skip number 4 and 5, but we'll come back to talk about how professionals can help you manage your financial property. So to start with, planning for your retirement. Well, when you start out and think about retirement, um, there are a lot of aspects to it. Many people would like to begin with thinking about, okay, what do I want my retirement to look like? Well, in the past, people who retired from a company basically walked away with a guaranteed defined benefit plan from the company. So they had a pension, and typically it was a fixed amount, so much per month, for however long the rest of their life was. And that would be a guaranteed payment, basically. And not that they weren't these funds, they were invested in investments and things like that, but basically the employee didn't have any control over where those were invested and really didn't have any responsibility for those investments. However, today, more employers are shifting to a defined contribution plan where they basically say, we're going to contribute so much of your income into a retirement fund, and that is invested according to what you want to see. So it sets how much you and your employer will deposit into a retirement account. And typically, this is a lot like a 401k or a 403b. And in these plans, you put your money into specific investments. And then again, hopefully the money grows. But there is risk involved because with a defined contribution plan, there is a risk that you will not, your interest or earnings will not accrue as quickly as you had hoped, and you may not uh, have enough saved for retirement, uh, as opposed to this, where you have a specific plan that they're going to pay you. Here's an estimated chart, well, a chart that estimates the amount of money you need to save for retirement if you were to retire at age 65. So if you were making an annual career income of $23,000, you need to replace in retirement 75% of that salary. So the amount of income you need to replace is 7,130. And if you're going to do that, you need to have $178,250 in the bank based on the assumptions made in this model. So I believe that's at 4%. Um, so if you look at that, you can see as your income goes up, the need for savings also increases. So at these higher levels of income, you're seeking to replace more income. And in order to do that, you have to have higher levels of savings. All right, well, in 1937, Social Security was implemented because many of the retirees from the Depression that happened between 1929 uh, and that time were retiring without any resources for their retirement. Basically, the Social Security was considered a pay as you go program where the government would collect the taxes and then pay those out to retirees based on the highest 35 years of earnings um, for those retirees. So essentially, what the government was doing was saying, because all of these employment resources collapsed in the 1929 crash, we're going to step in and create this fund based on the taxes of working individuals that will pay these retirees for retirement. And by the way, it's modest. It's not a lot of income, but it is some. So basically, that's where Social Security began. It began in 1937, which is now 83 years ago. It's been a long time. So if you are preparing for retirement, this chart will show you how at what rate you need to start saving. So if you start saving for retirement when you're 25, you need to save at 7.2% of your income uh, to prepare for that retirement at this level. If you wait until you're 45, you have to start saving 25% of your income. And likewise here, if you're trying to set aside this 1,000,006, you have to save 43% of your income here if you start at age 45. So that's a large, large amount. Um, the point here in this chart is to start early so you don't have to save quite at the same rate. Okay, this defined contribution plan that we mentioned a moment ago, it's a retirement account that you're going to fund. Uh, Basically, you're going to be, for most of them, you are the primary funder. Generally, what happens is you contribute a certain percentage of your income and your employer matches whatever you're contributing. Uh, some employers will require you to work a certain length of time in order to get that, and that's what we call vesting. So for my work at Blue Cross when I was there, I had to work there for 5 years before I became vested in the retirement plan, and so that happened. I invested in that plan. Um, in these cases, the defined contribution builds in an account designated for the employee. It's not necessarily a defined benefit, but that account will grow based on what the employee does with those savings. So there are four kinds of defined contribution plans. We'll go through those here. The first one is a 401k, which is what most people are familiar with. This is for employers, private companies, and basically in a private company or even a publicly held company. This is a for-profit company, and they're basically setting it up under this section of the IRS code, the 401k section. And basically, you are allowed to deposit a certain amount of money in that account, and you don't pay taxes on the deposits. However, when you receive them after you retire, you do pay taxes on that. The 403B is like a 401k plan, but it's really for a public education and not for profit companies. So if you work for a not for profit or public education, this is going to be the kind of defined contribution plan you have. The 457B is like a 401k, but it's really only for those people who are employees of a state or local government. So, in other words, people who work in public education are not going to get this 457B. If you work somewhere else, you're not going to get it. But basically, what this does, these three different codes allow all kinds of employees to participate in these plans. Um, so you're allowed to contribute to this pre-tax like you are in all three of these plans. Your employer may also contribute to it pre-tax. Um, the last kind of plan is this thrift savings plan. And this is for employees of the federal government. This is not the local or state. This is for the federal government, but this works like a 401k, and it's going to be very similar to the others, except it's under a different part of the revenue code. When you invest retirement funds, it's very important to think about what you're investing in. The goal, and this is not going to happen now, but the goal is to earn a rate of 4 to 5% on your money. That's going to be 4 to 5% higher than the inflation rate if possible. Um, you can do that in these retirement funds through mutual funds, target date funds. When I say target date fund, what I mean is uh, there are funds that they set up that target a certain retirement date. And so if you invest in a fund that has a target retirement date of 2030, that fund is going to have a mix of investments based on your goal to retire in 2030. So what happens is over time, the investments become more and more conservative as you get closer to retirement. So when you start out, you may be 15, 20 years from retirement. You can have more money in stocks at that point. But the closer you get to retirement, the more that money shifts away from the stocks and into the more secure investments that are less likely to lose money. Okay, this is an end of the topic assessment. Basically asking you what the difference between the defined benefit and defined contribution plan is. This is a good question to think about for our test when we have it in a couple of weeks. Defined benefit plans guarantee payments, whereas defined contribution plans make contributions to retiree accounts without making any guarantee. So that is the big difference. Okay, one of the ways that individuals prepare for retirement is through an individual retirement account, an IRA. And there are a couple of ways those work. One is the traditional IRA. And by the way, you get tax benefits differently from these plans. But in the traditional IRA, you're going to be able to contribute money into an IRA account and not pay tax on that money. And that's what this is assuming. This is assuming that you're going with a traditional IRA. You deposit the money and you don't pay taxes on the money you deposit. You can accumulate a significant amount of money with a modest contribution every year. So here's the traditional IRA model. Basically, you put money into this account, select investments, investments grow, and at the time when you get ready to retire, um, if you keep the money in the account, there's no tax until you retire or start distributing it. Or you can take out some money, but you start paying taxes on it. Now, if you take this money, that's when you retire. Now, if you take this out before you retire, if you take it out too early, you pay a 10% penalty on specific withdrawals. Although there are some exceptions for that, um, but you have to wait if you're going to use this in retirement until after you're 59 and a half years old. The Roth IRA was created so that you could deposit money into the account, an IRA, and pay tax on the money now, but not pay tax on it when you retire. The goal was to make the retirement income tax free. Um, these are good plans. There's nothing um, inherently wrong with a traditional IRA, but I was talking to my father one time after he retired, and he said, he wished that he had done a Roth IRA before he retired, partially because I think they were doing well in retirement, and he would have preferred not to pay taxes at that point. So I think that is an option. If you do a Roth, you're basically putting money in. You pay tax on the money you put in, but you don't pay taxes when you take it out. There are requirements for contributions that you have to have earned income. And basically, there are limits as to what you can contribute uh, based on your income. Um, you can contribute both to a traditional and Roth IRA, but there is this limit of $5,500 contributions that you can make to an IRA. So the annual contribution is limited, um, and it depends on which kind of IRA you're depositing it in and what kind of results you're going to have when you take it out. Also, you can't contribute to an IRA if you're older than 70 and a half years old. Um, I think that pretty much speaks for itself. I think most people would expect to be retired at that point or close to it. Now, if you are working for an employer, and you leave, you can roll over money into an IRA. Um, so if you are leaving and you have one of these investment accounts where it's defined benefit or defined contribution, and you say, well, I would like to have this rolled over into my IRA, they can do that directly and there won't be any taxes on that transfer. Um, Also, if you have a trustee holding your investment, you can ask for a trustee to trustee transfer and no taxes are withheld. Um, if, however, a distribution from a retirement is paid directly to you, you have a maximum of 60 days to put that into a new IRA or roll it over into an IRA. The example was given one time. A person was took the check from their IRA or from their retirement fund, was going to put it in their IRA. They got in an accident, they got delayed, they got postponed, they were in the hospital, and they didn't make it in time. So they wound up paying taxes on the disbursement from their retirement account. So the short, uh, basically, the point of that story is it's always better to roll it over because you don't take any chances. It's an electronic transfer, and you don't have any risk that you won't make it to actually do the rollover. So, if you want to reach a retirement goal, most of the times they're saying you need more than $1 million to retire. Um, if you're in your 20s, you want to save between 10 and 15% of your income. In your 30s, it's 15 to 25%, and in your 40s, it's 25 to 40%. So the keys to reaching a retirement goal is really to start early, to save a minimum amount of your income, 10% of your income for retirement. If you want to retire early, you need to save more. One of the ways to actually do this well is to automate your savings so that you're not having to put this in an account every time. You basically have it withdrawn from your paycheck, and you basically make that as automatic as possible so you don't have to think about it. And then invest aggressively. If you're still 30 or 40 years away from retirement, you may be willing to take well, you can take greater levels of risk uh, that may pay off in the long run. The last part of chapter 10 we're going to talk about are different kinds of financial professionals. So we have a financial planner, financial counselor, financial advisor, tax advisor, and legal advisor. These are different kinds of financial professionals. A planner is basically someone that will guide you, sort of give you a game plan, if you will, for saving or planning for the future. A financial counselor, on the other hand, is going to be somebody that'll help you out of a jam or some kind of a problem. A financial advisor will provide advice on financial topics. And basically, a lot of these folks are going to be product focused. In other words, they're going to be directing you towards some kind of an investment product. Um, and then a tax advisor is different altogether. They're going to be advising you based on the tax liability of a specific thing. So they're going to provide you some help with preparing your tax return and minimizing your tax liability. The legal advisor, these are going to be folks who help you with uh, legal documents like wills and so forth. So they provide legal advice and counsel, and they can draft these documents. So the certifications, if you're looking for a financial professional, there are different certifications you want to look at. Um, First of all, this chart lists them out, and I'm not going to read through every one of them, but I'm going to mention a few. The Certified Financial Planner, the CFP, the Chartered Financial Consultant, those are both widely recognized for financial professionals. And then a personal financial specialist, that's probably not as highly esteemed as the other two. The Chartered Financial Consultant and the Certified Financial Planner, they're basically they're going to be certified through a rigorous exam. Um, a financial counselor, there is a certification for that, the Accredited Financial Counselor certification. Um, but also, one of the things I wanted to mention is financial planner. They don't really list it here, but there are certified public accountants who also do these kinds of services. So the American Institute of Certified Public Accountants is one of the bodies that would regulate them. Oh, I see. They're down here. Um, so there are others here as well. And just know that you can reach out to these different kind of professionals as you will. But remember, if somebody is offering a product or a service and they want to charge you for that product or service, you need to question whether or not there's a conflict of interest involved in what they're in the advice that they're providing you with. A lot of times, tax advisors are CPAs. You can also be an enrolled agent, which is different from a CPA, but you can be a CPA and an enrolled agent. An enrolled agent is allowed to practice in before the IRS and represent clients, um, but uh, they have to take a very rigorous test to pass to get that certification. All right, so when we talk about comparing financial counseling and planning, like I said, financial counseling is really on a short-term basis, looking at a problem. How do I fix this? How do I get out of this jam? A financial planner is really long range. They're looking at, okay, where do you want to be in 20 years? Or what do you want to have in 20 years? Right now in the financial marketplace, you may have different ways that people earn their income. One of those is a commission, and it's paid to the financial professional not by the client, but from a financial firm. So if you go to one of these folks who are product focused and they direct you to a certain investment, it's important to know whether or not that financial professional is receiving a commission for doing that. And they may be, and it's legal. But just be aware of that and know before you go into certain transactions like that. A fee is also charged by some financial consultants, and this are financial advisors, and this would be charged to the client. The client would go in and pay for their service. This is much more upfront, and you understand right away, okay, I'm paying for this service, and you are representing me um, and my best interests. There's also could be a combination of the two, but before you become involved with a financial planner or a financial counselor or anything like that, make sure you understand how their fees are driven and whether or not they're going to put you into a certain kind of a financial product and whether or not they earn income from that. And that's what I was getting at right here is a conflict of interest. The problem is a conflict of interest occurs when a financial counselor says that they're representing you, but they're also representing somebody else who's trying to sell something to you. In other words, um, they don't have the distance from the product to be completely objective about it. So there are two levels of advice. There's two levels of standards. One is a suitability standard. Basically, it requires them to provide a suitable product, not necessarily the best. But then there's also the fiduciary standard of advice, which requires, which really, this is the highest level, requiring the financial advisor to give you or to act in your best interest and avoid and disclose any conflicts of interest. Uh, so, working with registered representatives can be beneficial, but you have to guard against being sold something that is suitable instead of what's in your best interest. Now, just one question for you to think about as we leave this chapter. What can a consumer do to get the best advice possible? And my short answer here to you would be do lots of research, do the due diligence, find out what the financial advisor or counselor is charging and why. So that really does cover chapter 10. Uh, the homework will be available in the morning along with the attendance quiz. And like I said in my announcement video, I'll be opening up the other assignments as well. So you can, if you have any that did not get submitted, go back, check, make sure you get those submitted. All right, take care, and we'll be checking up with you again next week.